how long the Fed has kept interest rates higher for longer, meaning the length of time from its last rate hike to the first cut. And you can see we're above average now. And you can also see the last 3 times this happened, when we were higher than even we are now, was a harbinger of the 08-09 global financial crisis. It was a harbinger of the tech and telecom bust in 97, 98. And in 1969-70, it was the harbinger of a recession.
According to Cathie Wood, the founder, CEO, and CIO of Florida-based asset management firm ARK Invest, the world is heading toward very interesting times caused by government's unstable monetary policies. During the latest episode of her monthly In the Know broadcast, Cathie discusses the Bitcoin halving, M2 money supply, and the importance of innovation as the global economy grows more uncertain and volatile. While discussing the Bitcoin halving, Cathie and Yassine El-Mandra, the director of digital assets at ARK Invest, compare Bitcoin's mathematically metered supply, which is hard-coded into the software, to the volatile monetary policies made by central banks worldwide. With every halving event, Bitcoin's issuance rate is halved, which helps hold the cryptocurrency's inflation rate steady until the next halving year. The monetary policy of central banks is in direct contrast. During moments of monetary easing, they inflate the money supply so much that the damage becomes almost irreparable. And when tightening, they cause just as much, if not more, damage. Cathie believes this is exactly what is happening with the US Federal Reserve at the moment. The central bank has vowed to keep rates higher for longer until the inflation battle is won. Cathie warns that this is a huge mistake that will throw the markets and economy into further turmoil, comparable only to the recession of the early 70s, the tech and telecom bubble, and the 08-09 global financial crisis. The ARK Invest CEO believes we are heading for another severe global financial crisis if immediate steps are not taken. We will now bring you clips from the video as Cathie discusses Bitcoin's mathematically secured monetary policy, the instability of the global monetary system, and how the cryptocurrency industry serves as insurance against this widespread instability. Please watch, like, and share this video, subscribe to the channel, and turn on post notifications for more videos like this.
This halving chart is, you can see the discipline here, as Yassine said. It's been mathematically metered, and actually we did a Bitcoin brainstorm with miners, and I think Yassine's going to tee that up in a minute. But this monetary policy basically was written in 5 lines of code. I did not know that until we did that Bitcoin brainstorm. It is so elegant, so simple, so straightforward. So in contrast, take a look at this. All right, this is M2's M2 growth, and it's a 4-year annualized percent change. So from March this month to March, or this past March to March 4 years ago, what is the monetary growth rate at an annual rate? That would be the last data point here, which is, you can see the black dash line. So that rate is about 8%. And actually, probably it's closer to 6%. There's a lot of data on this chart. But take a look at the 4-year growth rate of M2. And you can see it's all over the place. You can see in the 60s and 70s, it moved toward double digits, and we ended up with double-digit inflation in the late 70s, early 80s. It took a while to get there, and it seemed to be very sticky. And then after Chairman Volcker came onto the scene, I think that was 1979, he said, we have to get this thing under control. And he started choking money supply. And that momentum actually continued into the mid-90s. And then in the mid 90s, it was very interesting because it's somewhat similar to today. In the mid 90s, there was a domino effect of currency devaluations around the world. Our monetary policy was propagating throughout the world because it is the world's reserve asset. And the first devaluation actually was Mexico. And it was a big one. I remember it very clearly because we were involved with Mexican stocks. And then a few years later, we had the Asian domino effect. I think the Thai baht devalued in 1997, and then the rest of Asia's currencies devalued. We had the Russian default in 1998, and then we had long-term capital falling apart. Monetary policy propagates through the system, and when it's so unpredictable, it leads to all kinds of excesses. And so what do we have now, where we see what happened because of COVID? That drove the 4-year annualized growth in M2 up to 12%. And then now we've had a very sharp deceleration, unlike the 70s, 60s and 70s, where there was sort of an acceleration, at least in the sense of a trend, and a stabilization near double digits. Here we had money thrown at the system to prevent an outright depression. And if by the end of the year we stabilize around 0% year-over-year growth, that's year-over-year, this line will drop toward 2 to 3%, which, as you can see, we've only seen once. It was in the 90s. And, after that, all hell broke loose around the world.
Cathie warns that the Fed's insistence on holding interest rates is wreaking more havoc on already weakened economies. At least 3 currencies have undergone multiple 40 to 60% devaluations against the US dollar over the past year. The Egyptian pound has lost more than 2/3 of its value against the dollar in a series of staggered devaluations since early 2022, when the foreign currency shortage worsened. The situation is even worse with the Nigerian naira and the Argentine peso, which have also been greatly devalued in the past few months. Fortunately, anyone with a connection to the internet in any of these countries can easily buy an insurance policy in the form of Bitcoin. This has helped millions in emerging countries avoid the steady debasement of weak fiat currencies. Plus, even developed economies are beginning to show signs of trouble, and Cathie believes the situation is about to get much worse. Here are more clips from the video.
We're in a very interesting environment, and it's caused by monetary instability around the world. And so I often talk to Yassine about these devaluations. And of course, in emerging markets, anyone with a connection to the internet now pretty much can establish or buy an insurance policy in the form of Bitcoin, which, just flipping back to the halving in this purple line, doesn't look anything like the volatility you see in monetary policy here in the United States and around the world. And of course, it's controlled by human beings. When we went off the gold exchange standard and closed the gold window in the United States in 1971, monetary policy just became unhinged, and it has been unhinged ever since, although human beings have tried to contain the inflationary ramifications, and they take it too far both ways. And right now, we think they're taking it too far on the downside. Here's the real Fed funds rate. So the Fed funds rate is roughly 5.5%, and 5 to 5.5%. And you can see the minus 3% gets us to 2.5% there. if inflation does come down the way we expect and the Fed does not cut rates, which the markets now don't expect one until November, if they don't cut as inflation's coming down, then this line is going to go out closer to 5%. Again, we haven't seen that really since the 80s, when inflation was still considered embedded or at risk of going back to double digits. We're nothing like that today. On the next page, this slide is how long the Fed has kept interest rates higher for longer, meaning the length of time from its last rate hike to the first cut. And you can see we're above average now. And you can also see the last 3 times this happened, when we were higher than even we are now, was a harbinger of the 08-09 global financial crisis. So that was 06-07. It was a harbinger of the tech and telecom bust in 97-98. And in 1969-70, it was the harbinger of a recession. Just a quick note on fiscal policy. You can see the deficit. We present this each time, and just want to reinforce that the antidote to this deficit, which in a so-called expansion is at 6.5%. That really has not happened except in the aftermath of the 08-09 meltdown, while stimulus was still flowing freely in response to it. But we're not in such a meltdown now, and we do believe growth is going to be the solution, as it was in the 90s. You can see the 90s in the Clinton administration for the most part. We ended up back in a surplus, which was a function of the very good growth. And
Like it happened when the internet started to take off in the 90s, Cathie believes we are upon another technological revolution that can easily take the global financial system from its current gloomy trajectory towards a more promising one. According to the ARK Invest CEO, artificial intelligence will be a huge catalyst for what's coming next. It will accelerate the growth of other innovation platforms, including robotics, energy storage, and blockchain technology, and together, they will change the trajectory of the world's economy. Cathie adds that as long as our governments are willing to make a few concessions that will help hold the global economy steady, until these platforms are ready to take off fully, we should be able to avoid any major meltdown. Do you agree with Cathie's analysis that we can somehow find a way out without any lasting damage to the financial system? Please drop your comments and observations in the comments section below. Also, ensure you subscribe to the channel and turn on post notifications for more videos like this. Thanks for watching.